Hello everyone and welcome to the special NFO series with Mirae Asset Sharekhan. We'll be speaking with top AMC leaders and fund managers to decode their latest launches. We'll understand what's driving these launches, the philosophy, strategy and objective of these schemes, and of course, what it means for you as an investor. Today, we'll decode the Access Multi-Asset Funds of Fund with the fund manager, Mr. Devang Shah. Let's dive in. Hello, Mr. Devang. It's really great to have you here in this special podcast.
Thank you.
So about this fund that you're launching soon, the Multi-Asset FoF, what would you say is the philosophy behind this fund and how is it relevant right now?
So thanks first of all for this important question. I think this sets the tone right for how we're going to look at the fund going ahead. At this point of time, I think there are a lot of uncertainties in the market, and you look across at each of the asset classes, they have a headwind as well as a tailwind. There are, if you look specifically when you look across at gold today, I think gold has given, or precious metals have given phenomenal return in the last 12 months. But today I think people are now started questioning about, will this rally continue? And there can be headwinds around that, whether the dollar will depreciate further, which will lead to more gold buying. How is the demand supply dynamics stacking up for gold? So there are, I think at this point of time, a lot of concerns and questions. Similarly goes with an equity as an asset class. Like we have in the last 12-15 months, a lot of positives around policy making, regulations. We have seen rate cuts, we've seen fiscal consolidation, we have seen fiscal impetus, like we've seen GST cuts. So all this has been the tailwinds for equity, but at the same point of time, I think valuations has been the bigger concerns for our markets. Second big theme which has been missing from Indian equities has been this entire all AI oriented theme, where in the last 12 months, other developed markets or emerging markets have seen a lot of flows and seen an increase in the market capitalization. So I think at this point of time, we see a fair mix of both, where each of the asset class has a headwind and a tailwind, and that is why it becomes more and more important to focus on asset allocation as a theme. For us, I think at this launching this fund, and you asked this question, why this fund and how this fund makes sense at this point of time, I think a disciplined asset allocation for an investor incrementally is becoming more and more important, and that is where we are focusing on.
Okay, so as you rightly said, during times like these, having asset allocation as an investor is extremely important. Right. So when you talk about asset allocation in this particular scheme, can you tell me a little bit more about what asset classes this scheme is investing in and how is it investing in also to what extent?
Right. So you have two questions. One is what will be the overall limits across which the SID of the fund allows us to invest into.
Yes.
I think it's like completely dynamic. So this fund actually gives you an opportunity somewhere down the line, the fund manager, the flexibility to maneuver his allocation across various asset classes.
Alright.
Equity has an allocation, it can maneuver from 10 to 80, debt it can move from 10 to 80, and commodities it can move from 10 to 35. So I think the fund of fund structure allows you greater flexibility. When you look across at the second aspect, which you spoke about, how the fund is going to allocate and decide about its allocation among various asset classes, the fund will have, I think the first important variable would be the asset allocation model. The asset allocation model, we have been using this model now since 2018, and this model has actually helped us a lot in deciding the asset allocation across various asset classes over various market themes. Are the four pillars which are actually very important and crucial while deciding the asset allocation model has been, I think, the macro parameters, the valuation parameters, which takes into consideration relative valuation of Indian markets versus emerging markets, global markets. Macroeconomic indicators include a lot of indicators. The third would be trends, and somewhere down the line we also look at technical factors. So these are the important variables which we look across at while deciding the asset allocation. The asset allocation is also guided by an internal committee which is chaired by our CIO, head equity, head debt. All of us sit together and decide across, along with the fund managers, if there are any narrow themes and some tactical opportunities available in the market to decide while allocating. So these are the, I would say, the broad frameworks how we are going to allocate across various asset classes.
Okay, so you mentioned that this is a dynamic asset allocation scheme, right? So how do you plan to change the asset allocation or adjust the scheme according to changes in market cycles? And how can you protect investors with dynamic asset allocation?
So see, I think trends have shown, if you look at the last 15, 18 years returns, okay, and when you look across at the daily rolling return of various asset classes and you look at the individual performance of each of these asset classes, you see that an asset allocation theme, which is like a 1/3 of each of these asset classes, which is debt, equity or commodities, vice versa, you pick up certain asset class like in a certain ratio depending on the age of the investor, depending on the underlying goals of the investor. The asset allocation outcome over the last 15, 17 years using these models actually leads to significant stable returns with 50% of the volatility which the individual asset classes have provided. So, example, if I look across at equity as an asset class, the returns of an asset allocation model might be similar or roundabout on a theme where you have given this 40 20, where 40 is percentage allocated to equity, 40% allocated to debt and 20% to commodities. I think the outcome is quite similar with significantly low drawdowns and low volatility. And what do I mean by, in simple terms, low volatility? It's the lower standard deviation and lower drawdowns in case of abrupt market environment. So our view or our assessment out here is that asset allocation actually ensures investors in a market which is uncertain, in a market where there can be choppy trends, it actually helps you from an investor from a drawdown and reduce the volatility of the return for the investor.
Okay, so the core intent over here is to reduce and deal with volatility.
Right.
Right. So this is a funds of funds schemes, right? So can you tell us, just for our audience, for our investors, what is funds of funds and why is this scheme a fund of funds scheme, and what funds will this be investing in?
Right. See, so obviously a fund of fund is a great structure. I think somewhere down the line very good for an investor.
Okay.
Because when we are looking across at if the investor today, like today he wants to probably decide across that I want to look at equity as asset class, but tomorrow if the overall market view changes and there's a complete risk off and he wants to move out from equity to gold, he has to pay exit load, he has to pay taxes, there are too many hassles which an investor will have to go through. Here a fund of fund structure actually allows the investor, it gives the flexibility to the fund manager to maneuver his allocation according to the market cycle. As I explained to you, we have actually done some work. If you look at the last 15 years also, be it 2008 to 2013, gold came out to be a clear winner as an asset class. 2014 to 2019, debt came out in India to be a clear asset class, and 2020 onwards it was equities. So the point of view is, through a fund of fund structure, the investor can benefited by, without paying any exit load, without paying any taxes, the fund manager will maneuver it depending on the market environment, his allocation, and which will lead to overall stability in his returns and somewhere down the line reduce the volatility in his returns. So that is how the fund of fund structure works. The second part I think which investor needs to know is that for a fund of fund structure, the investment horizon which he should have is minimum 2 years, because the tax efficiency doesn't kick in. If I give you some perspective on the taxation, below 2 years investment for a fund of fund, it is actually taxed at a marginal rate. Above 2 years, the investments which are held into the fund of fund structure, it leads to around 12.5% taxation. So our assessment is that investor who wants to probably take the view on various market cycles without paying exit loads, somewhere down the line reduces tax burden and completely come out as a good solution, I think his investment horizon should be more than 2 years. You had a second question about what will the fund do currently,
yes,
and how likely it would be the asset allocation at this point of time on the basis of the market environment.
Yes.
Obviously, see, the market environment has, if you look at the last 12 months, our equity as an asset class has not performed in India. Like if you look at comparison to the relative to the rest of the world, Indian equities haven't done so well. Gold and silver has given phenomenal returns. I think debt also, because of the rate cut cycle and lot of actions from RBI on liquidity front, open market operations, they have given good returns over the last 12-18 months. We believe at this point of time, yes, the fund, obviously, and it will keep on changing on the basis of the macro environment, but today there will be a tilt towards equity, some part of it towards commodities and the rest of it towards debt. On the debt side, we'll probably look at in the current market environment where large part of the rate cycle is over, we will be looking at accrual as a theme and probably capturing the short to medium term funds. On commodity side, we will probably have a slightly higher allocation towards gold, but the overall commodity allocation might be lower. And on the equity side, at this point of time, we believe that we will be focusing on various themes which are coming across good from a market perspective, and focus on underlying funds which ensure stability into the portfolio with lower volatility and lower drawdowns. So that's the overall perspective the fund will look at.
All right. And you also mentioned that the minimum time horizon that you recommend for investors is 2 years, right? To derive those benefits like tax benefits or lower exit load, etc.
Also enable investor to capture all market cycles.
Got it. At least 2 years to capture market cycles. So what kind of investor should go for the scheme according to you? What kind of demographic or what kind of objective should they have so that this is the right fit for their portfolio?
See, my understanding is, first of all, investor needs to understand that somewhere down the line, these are products where today you are very completely uncertain about where should you invest into. This is a dilemma which investor has. That, as I told
too many choices.
Too many concerns also, because you have, along with the choices of various asset classes, as you rightly highlighted, there are headwinds or tailwinds for all of these asset classes. So it is difficult to choose how to allocate, and equities are not cheap. Gold and silver, as I told you, have delivered phenomenal returns. Large part of the fixed income cycle is behind us. So now what an investor would do, where he will probably get the next set of returns. So I think first of all, it is important for investors to understand that when you're targeting all of these, this probably a fund of fund structure where you're using a diversification of asset allocation, and somewhere down the line you are targeting an asset allocation theme. You should be probably looking at a minimum 2 years to 2.5 year investment horizon, as I told you, because it helps you to capture various market cycles, and somewhere down the line it allows the fund manager also to probably somewhere down the line pick up those right themes for him, which will give the investor stability in his performance. So I think minimum investment horizon should be 2.5 years. Is it from my perspective, it is a product for everyone, Nivedita. It's like for people like you, people like me, in various age groups. Obviously the tilt can be slightly more aggressive for a person who has just joined his job and is in his first job, probably at the age of 25. Probably he might have a higher allocation towards pure equity funds, and somewhat lower allocation towards such multi-asset funds. But I think a multi-asset fund today, in an uncertain environment where markets are choppy, we would want to probably, as you to still identify the right theme to get the right investment solution for your client. I think it becomes an important part of a portfolio for all investors.
Okay. And now that you've explained what kind of investor this is suited for, what are the risks that the investors should know about, that they should consider before investing in this scheme, and also how does the scheme manage these risks?
So see, another two perspectives. First of all, as you highlighted, because it's somewhere down the line investing in all the asset classes, so there will be those pertinent risk of the underlying asset class. Like equities, we have all seen, I'm sure we have looked at the last 10, 15, 18 years, the volatility in the asset class is significantly huge. Similar is the case with precious metals like gold and silver. They also offer huge volatility. So our perspective is very clear that yes, investor needs to understand that these are products which comes across with as a PRC matrix also, these are classified as highly risky products.
Okay.
Now the important perspective is, when that is why we said there are 2 or 3 important messages which an investor should always focus on while investing in such funds. First is his investment horizon has to be longer, and as you highlighted, I think it is the minimum investment horizon of 2 years, the tax efficiency to kick in. All of these parameters are like, I would say the minimum investment horizon has to be slightly longer for the fund manager also to capture the right investment cycle. But I think investors should be aware that these products do have inherent volatility because of the underlying asset class. How do we manage those risks? I think the 2-3 basic, I would again thrash out the 2-3 big differentiators which probably will help you out to explain your investors that how are we looking at managing the risk, underlying risk. The most important perspective is, first is that we are going to actively manage the asset allocation. This is our model which is time tested, which captures various parameters like macros, valuations, underlying themes. This is not only going to be a pure model based fund, it is also going to be guided by an IC. The internal committee, which is again, as I told you, chaired by all the heads on investments, fund managers, will help us to select the right theme, which will help us to probably see that okay, if certain markets, certain pockets of markets are expensive, to avoid those risks. So we are looking at trends, we are looking at relative valuation. So that will all help us to maneuver the asset allocation. I think these are the more big, I would say, differentiators which will probably help us out to somewhere reduce the volatility into the return and risk for the investors. But I'll again highlight that these funds come out with a minimum horizon, investment horizon of 2 years, and these products, as the PRC matrix classify it, is considered as a risky product.
Thank you so much, Mr. Devang. It was really great having you here today, and it was great hearing about everything about this multi-asset scheme and why investors should consider this right now and how it is relevant today.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully before investing.